Hello everyone. So today we'll be studying about types of investment options that you should know in your 20s. As it is said the best time to invest when you can take risk in your 20s, but for that you should know where to invest. For that today I'll be telling you not 10, not 20, but 22 such options. So here's the list of those investment instruments. Further we will be talking about them in brief. So the first option available for you to invest is equity investments. Equity investments involve purchasing of shares of companies listed on stock exchanges like National Stock Exchange or Bombay Stock Exchange. Here, what you receive in the end depends on market volatility. There is a saying of buy low and sell high to gain more interest. But for this, you need to have market understanding, like when to buy and when to sell, or you can appoint someone to manage for the same. Today, to invest in equity, all you need is open any broker app like Zerodha, Grow, Angel One, etc. Create an account, choose your stocks wisely, and simply click to invest. The process is very simple. Comment down below if you need a step-by-step guide to how to create an account in a broker app and how to invest your money. Moving on to the next slide, we have fixed deposits. Fixed deposits are time-bound deposits offered by financial institutions and are considered as one of the safest form of investment instruments. This is the investment instrument that you would have heard from somewhere, from someone who can be your father, sibling, and even our grandfathers have invested in this. As per RBI guidelines, your money invested up to 5 lakhs is insured by the banks, and you can also get a decent return from your invested money. Pro tip from my side, you can get loan against FD at lower interest rates. Today, FD provide 7 to 8% of interest rate. Even in case of few small finance bank, it goes up to 9.5%, who also get insured up to 5 lakh rupees. These are those small finance banks, Unity and Utkarsh Small Finance Bank. Comment down below if you need a video on current FD rates of all nationalized as well as private and small finance banks in India. Moving on to the next slide, we have mutual funds. Mutual funds pool the money from multiple investors to invest in stocks, bonds, and other assets. You would have heard this line on television. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. So what are mutual funds? Remember when in equity investments I said you can appoint someone who have the market knowledge to invest your money. So here is where mutual fund helps. We can find different fund houses who have already appointed experienced professionals. These individuals know where to invest your money so that it will give the best interest. You can also choose a fund like index fund where your money is invested in top 50 companies of India. Pro tip from my side, always select a direct plan over regular one. If you invest, be a broker. Comment down below if you want to know my top 10 mutual fund picks and have a detailed explanation on the topic mutual funds. Moving on to the next slide, SIP or Systematic Investment Plan. SIP is a method of investing in small amounts regularly in mutual fund. Here a fixed amount of money is debited by investors' bank account periodically and invested in a specified mutual fund. It promotes disciplined savings and leverages rupee cost averaging to reduce market risks and is suitable for long-term wealth creation as its benefit arises from compounding. This is the best medium for salaried person and for those who don't check market frequently. All you need to do is set a monthly date, choose a fund and forget. Money will be automatically debited from your bank account and invested. Today, people prefer SIP over FDs due to high interest rate in SIP, which is usually over 12% in last 5 years. Also due to features like we can change the amount, date and even skip the next installment. Moving on to the next slide, we have exchange traded funds or ETFs. ETFs are fund traded on stock exchanges that track indices, commodities or sectors. To simply understand ETFs, imagine yourself in an Indian restaurant. You have various dishes in the menu, then in the end there is a veg thali. So ETFs are those thali or combo of shares that are made for convenience of investors. For example, you can find a pharma ETF where the top stocks in the field of medical and pharma are present. So through these ETFs, you can invest in a particular sector or type of stocks. But like shares, they are also volatile and needs market understanding. So invest cautiously in any ETFs. Also comment down below if you need a video on my top picks in ETFs. Moving on to the next slide, we have IPO, initial public offering. An IPO is when a private company offers its shares to public for the first time to raise funds. You can say an IPO is a game of luck. Either you get allotted an IPO or you are not. If you get allotted, you can redeem them right away or wait for their bull run. time. For example, my friend applied in Bajaj Housing IPO in September and he doubled his initial investment value after allotment. But to be cautious, not all IPOs are profitable, some underperform and results in loss later. So if you have 15k lying around, you can check out your luck and apply in an IPO. Here money gets logged in. If you are rejected, then money is transferred back to the bank account. Next is bond and debentures. Bonds are fixed income securities which the insurer borrows money from investors and pays interest periodically with the principal repaid on maturity, whereas debentures are unsecured debt instruments issued by companies to raise funds. Unlike bonds, they are not backed by collateral and rely on the issuer's creditworthiness. Types of bonds include government bond, corporate bond, municipal bond, zero coupon, convertible and non-convertible. Comment down below to get a detailed video on this topic of bonds and debentures. Moving on to the next slide, we have Treasury bills or popularly known as T-bills. These are short-term debt instruments issued by government with maturity of 91 days, 182 days and 364 days. These are issued by RBI on behalf of Government of India. Compared to other investment options like equity, corporate bonds, T-bills offer lower returns, but as they are backed by government, they are risk-free. Moving on to the next slide, we have sovereign green bonds. Sovereign green bonds are government issued bonds used to fund environmentally sustained projects such as renewable energy or clean infrastructure. Like traditional bonds, green bonds typically offer modest returns, making them less appealing to the young investors. RBI manages the issuance process, aligning with the international green bond principles for credibility. Moving on to the next slide, we have unit-linked investment plans or ULIPs. ULIPs are financial instruments that combine investment and insurance in a single product. They allow policyholders to invest in various market-linked funds such as equity, debt, or balanced funds, while also providing a life insurance cover with a 5-year mandatory lock-in period. It is often compared with mutual fund, but the best benefit of ULIP is no LTCG, which means it is tax-free on maturity, unlike mutual funds with 20% short-term capital gains and 12.5% long-term capital gains. But people often stay away from ULIPs due to high fee and hidden charges. Also, some people prefer to keep their life insurance cover and investments separate. Moving on to the next slide, we have real estate investment trusts or REITs. REITs are investment in income generating commercial properties through stock exchanges. These are similar to mutual funds, where in mutual fund the fund house buys share of various companies from your investment. Here in REITs, they buy commercial properties like office buildings, apartments, shopping mall, etc. and it rents them. Then this rental income earned by REITs is its income. As the valuation of the property increases, its income increases. Then this income is given to its shareholders who invested to pool the money to buy the property in the first place. Comment down below if you want the list of REITs and a more detailed video on the same topic. Moving on to the next topic, we have infrastructure investment trusts or InvITs. InvITs are vehicles designed to pool funds from various investors to own, operate and manage infrastructure projects such as roads, bridges and power plants. You might find them similar to REITs. These invest in infrastructure projects like highway, powerhouse, transmission lines, bridges, forts, etc. Hence, now if you pay toll tax, you can actually earn from it. Moving on to the next slide, we have recurring deposits. RDs is a fixed deposit investment that helps individuals to save regularly over a specified tenure. These are low risk investment as they are not affected by market fluctuations, but the returns are so less they hardly beat the inflation that comes in the long term. Hence are less used means of investment instrument today. Moving on to the next topic, we have international funds and stocks. Like domestic investment, we can also invest in global markets through mutual funds, ETFs, or direct stocks. In India, you can invest in US stocks like Apple, Microsoft, Amazon, etc. via IND money. Also, you can invest in international stocks via ETFs like Nasdaq 100, Hang Seng Bees, Mafang ETF, etc. These are popular international ETFs in India. Comment down below if you need a list of all these ETFs and a detailed video on the same topic. Moving on to the next topic, we have depository receipt. DRs or depository receipts are financial instruments that represent ownership in shares of a foreign company and can be traded like any other securities. These consist of ADR, GDR, IDR and EuroDR. Depository receipts are different from shares as they enables investors to invest in foreign companies without without dealing with cross-border complexities. Comment down below if you need a detailed video on DRs and their different types. Moving on to the next topic, we have startup investments via crowdfunding. Crowdfunding is a method of raising capital by collecting small amounts of money from a large number of individuals, typically through online platforms. In contexts of startup investments, crowdfunding allows entrepreneurs to fund their business by tapping into a broad pool of investors, ranging from retail to seasonal investors. Popular reality show Shark Tank India is based on the same concept. They fund startups and take certain stakes in the company based on their valuations. Investment in startup is like a gamble. If it turns out great, then high returns. If it fails, then nothing. Hence, it is a high risk, high return bet. Comment down below to get a list of crowdfunding platforms and a detailed video on the same. Moving on to the next topic, we have Public Provident Fund (PPF). It is a long-term savings scheme backed up by government with a 15-year lock-in period. The Public Provident Fund is a secure and tax-saving investment option regulated by the Public Provident Fund Act 1968 for a long-term wealth creation. With the fixed tenure, its guaranteed return and tax benefits make it an ideal choice for conservative and disciplined investors aiming to build a secure financial future. Moving on to the next topic, we have NPS, National Pension System. It is a retirement-focused scheme regulated by Pension Fund Regulatory Development Authority. NPS is a government-backed voluntary retirement savings scheme. It is designed to provide financial security post-retirement by encouraging regular saving during the working years of an individual. You can also withdraw up to 25% of contributions after 3 years for specific purposes like education, marriage, medical treatment, etc. Comment down below to get a detailed video on NPS and to know the requirements for how to open an NPS account. Moving on to the next slide, we have Employees Provident Fund (EPF). It is a government mandated retirement savings scheme managed by the Employees Provident Fund Organization (EPFO). It is designed to ensure financial security for employees after retirement. Although NPS and EPF may seem similar, but the chief difference between EPF and NPS is that while EPF provide guaranteed tax-free returns in the form of annual interest on the sum deposited in the EPF account, NPS offers market-linked returns. Your investment in NPS is riskier than in EPF investment, but it also has the scope of offering better returns. So you can choose either as per your risk capacity. Moving on to the next slide, we have Senior Citizen Savings Scheme. It is a government-backed savings scheme tailored for individuals aged above 60 years, offering secure returns and regular income. It is a popular investment choice for senior citizens seeking financial stability post-retirement, which is backed up by Government of India, hence is secure. The scheme has a maturity period of 5 years, extendable by an addition 3 years upon application. The minimum deposit is Rs 1,000, which goes up to maximum of 30 lakh. Comment down below if you need a detailed video for the same and how to apply in senior savings scheme. Now let's talk about other government-backed schemes. Schemes like Atal Pension Yojana, Sukanya Samriddhi Yojana, National Savings Certificate, and Kisan Vikas Patra. Here, Atal Pension Yojana is a pension scheme for unorganized sector workers, for example, domestic workers, fishermen, barbers, vegetable and fruit vendors. In this scheme, you can start with a monthly contribution from the age of 18. Next is Sukanya Samriddhi Yojana, is for parents of girl child, where saving for a girl child's education and marriage is done up to her age of 21 years. Next, the National Savings Certificate is a fixed income investment scheme designed to promote small savings and financial security among individuals. NSC offers a fixed tenure of 5 years and provides an attractive interest rate of 7.7% per annum. Next, the Kisan Vikas Patra is a long-term savings scheme, which was initially introduced in 1988 for farmers. It is now available to all the citizens and aim to promote financial security through guaranteed returns. Schemes popular in India. Here I have provided the current interest rates of few of the popular government schemes in India. Comment down below if you need a detailed and separate video on all major government-backed schemes popular in India. Next up, we have gold and other commodities. Gold, which is the oldest form of investment option used by Indians. Also, it is often seen during market downturns or periods of economic instability. Investors tend to seek to invest in gold. Hence, when the market goes down, the price of gold, silver, and other precious metals increases. Today, Gold investment includes not only physical gold but digital gold and gold ETFs, where you need not to hold gold physically and pay the bank locker price. Also, there are oil ETFs available as investment in other commodities. Investing in gold and other commodities can enhance portfolio diversification and provide a hedge against inflation and economic instability, hence our preferred choice of conservative individuals. Setting aside these 22 investment options, there are also some other options like cryptocurrency. Cryptocurrency include Bitcoin, Ethereum, or Solana traded on decentralized platforms. These are high risk, high return investment options with global access potential for significant growth and blockchain technology. In India, it lacks of regulation, have security concerns, and are super volatile. Hence, I would not recommend. But investing in 2010, if you would have invested in crypto back then that's another story. Then you can also invest in real estate, buy your own commercial property like in REITs. You buy a portion. Here you physically buy a property, then put it on rent, lease or hold and sell in future when the price of property increases. These require huge capital, hence are not for beginners. Thank you. Do like, share and subscribe.